So we're overcoming Web3 hurdles for financial institutions. That's the topic I've asked to speak about. Okay. So for what I'm going to cover, I'm going to give a bit about my background, just under quickly what is Web3, looking at some blockchain fundamentals, and then we'll cover DeFi and TradFi, and with Q&A in the end. And the real question I've got is, why is DeFi only a small fraction of what is TradFi? And why is TradFi struggling to implement um, what's blockchain or Web3 technology at scale? And throughout the presentation, I'll be highlighting the hurdles for financial institutions as we go through each of these topics. So I started my career as a manufacturing engineer. I used to build engines for Ford. But 3 years out of university, I decided to take a step back. I joined a graduate training program, what was then Chase Manhattan Bank, for operations management. And so I got involved with products, global businesses that are dealing with the settlement and recording of transactions across global markets. And I've subsequently worked for Chase, Morgan Stanley, Goldman Sachs, Bank of America, BNY Mellon. I've also consulted independently and through boutique consultancy with the depositories, with the big fund managers, with the administrators. So I've had a long career in dealing with the infrastructure of institutional finance around the world. And so when I saw blockchain, I got excited because of what I saw of some of the challenges. However, what I want to do is bring you back to when I first joined banking. I'm an engineer, so I want to try and decipher this industry. And there was 2 scary things that I learned when I joined banking. One of them was that there's no such thing as an incorruptible process. And this also applies to blockchains. Blockchains are often said to be immutable. They're not. They're actually corrupt evidence. So it's not that they can't be corrupted, it's just that they're very hard to corrupt. And in financial services, you can never protect yourself from collusion. So there's controls in place just to ensure that, you know, that if you're going to do something by mistake or worse, nefariously, that it makes it very hard to do, which is one of the reasons why bank vaults are in the basement and behind big steel doors. So it's very hard to get to and it's very hard to break into. In the same way, when you're dealing with technological processes, you're trying to make it very hard to corrupt. The other thing I found out was that banks are effectively insolvent. Although there's the famous bank robber that said, you know, why do I rob banks? It's because that's where the money is. Technically, a bank, if it has its money, it's lent it out. So it really is, on a cash basis, nearly insolvent, which is kind of scary, because here I am thinking, you know, I'm taking on responsibility for protecting these assets, and I'm actually being told there might be no way I can actually completely protect them. And by the way, the money and everything I'm protecting might not be there anyway in the first place. But forget about it not being in the bank. There was a third thing I learned about later, and we're going to cover this later in the presentation. The fact that most of the money in the world doesn't actually exist. So the thing I'm protecting is not with me and doesn't exist, and I can't fully protect it. So those are just some of the things that you have to deal with or understand from a fundamental perspective of banking. And we'll cover why this is important. So looking at Web3, the term was coined by Gavin Wood, who was one of the founders of Ethereum. And really, Web 1 was static web pages. Web 2 was when we started interacting with each other or other groups, but they were mainly centralized groups, social media sites, or even transaction sites, you know, like Amazon, but they're really centralized. So the idea of Web 3 is that if we can use blockchain and have distributed data, we can actually decentralize the internet, and that creates more opportunity and privacy and transparency for the individual. And that's the real goal. So what is blockchain's potential? Well, with a distributed ledger, you have this ability for peer-to-peer or B2B bilateral record settlement without a central authority, which is often needed. And in some cases, in the pure state, there's no intermediary, like Bitcoin. However, the idea of getting rid of intermediaries is not really realistic. Central authorities, yes, but you go through the internet, through your internet provider. You're going to go to you know, crypto via an exchange. So it's not so much worrying about intermediaries, but it's the idea that you can transact with your counterparties and do that without the central authority. The settlement itself now is in hours, if not minutes, or even seconds, rather than days, where you're dealing with transactions or market settlements. And you've got reduced errors and exceptions and reconciliations. While I accept there will definitely be a reduction, blockchain does not get rid of the need for reconciliations. It might reduce the number and make them less error prone, but you will still need to reconcile your blockchain. It creates increased transparency and asset liquidity because of the speed and by the nature of the distributed ledger. And then there's a potential of whole new products and processing capabilities we can't imagine, just as we couldn't imagine Amazon before the internet. And the two main use cases are really, one is to have the transaction network, which most people think about, but there's also this ability to store and sharing and synchronize data. And often banks and brokers have multiple ledgers that are running in parallel that then have to be reconciled and tracked. But the real potential of blockchain is every time you transact in the markets today, you're dealing with a different set of infrastructures. So most of the big banks and brokers are charging you a toll to give you access to those infrastructures. In the same way the internet protocol unified communication, distributed ledgers have a potential to unify transactions as a unified ledger, as a consistent transaction protocol. But now looking at blockchain, that's its huge potential. What's its limitations? Well, the first blockchain was actually created by Stuart Haber and Scott Stoneder in 1991, and their white papers and articles are cited in the 2008 Bitcoin white paper. They were looking to create append-only corrupt evident databases, updates. So if you hash link the data, if the data is changed in any way whatsoever, then the hashes don't work and you've got the evidence of the corruption. And the idea was, can you trust digital or electronic updates? Now, in a distributed ledger, every node has a copy of the blockchain. So corruption or error would have to be replicated or accepted in greater than 2/3 of all nodes, according to the Byzantine fault tolerance. So this is extremely hard to do, and this is why I say, although blockchains are not incorruptible, they are very hard to corrupt. Bitcoin, you need greater than 51% of the mining capability or computational power. In consensus, you need at least greater than a third bad actors or greater than 2/3 good actors to be insured. And even with validators, there's a potential for corruption. So the point, though, is that the real exposure is at the next block. So when you look at consensus algorithms, the problem is that consensus is a multi-person, multi-step process. And when you're looking at all the votes, you've got issues of latency, you've got issues of computational scalability, because it gets exponentially bigger as the more votes and voters increase, and there's a capacity throughput issue. There's also a memory scalability issue, because the current blockchain designs require you to keep the blockchain from inception to current day in active memory, because the only reference to any balance that you have is in the block it was created, whether that was today, yesterday, or 3 years ago. And if you look at independent ordering services or validators, just a second. What just came in? They represent transient finite processing capacity and still have arbitrary latency, and they still have the memory scalability issue. So you've got this issue of scalability and capacity. And any sharding, roll-ups or other layering techniques increase the total additive capacity, but not actually increasing the actual capacity of the process. They introduce more latency with the separation between the shards, the roll-ups, and the layers. So from a processing perspective, they may create one benefit, but introduce other problems. So first two candidates for our requirements are high capacity and scalability. So we're going to have this parking lot where I'm going to keep track of all the requirements as we go through the presentation. So going to TradFi now, for any transacting network, the two major problems is the lack of interoperability. They're dedicated, and the cost of errors and exceptions. Networks are dedicated, customized to their use cases, and networks have multi-step optimistic processes. When you say optimistic, they use to hope that it will work, and our reconciliations and exception processing will track whether they did. So when you look at these dedicated customized networks in traditional finance, you can't transact with each other across these networks. They have inflexible central counterparties which do what they do but nothing else. And they create systemic risk. There's concentration risk. And then even if you think of money, it's the most fungible of assets, yet it's transferred through dedicated and centralized networks. There's multiple payment rails, there's multiple transfer rails. So even though money is very fungible, it still suffers. The real answer was to create, as I said, a consistent transaction protocol. Why can't we talk the same language? If you look at transactions on a normal basis, and this is surrounding sort of capital markets trades, and even to a certain extent like a credit card payment, what do? Well, the two parties agree a transaction, they record it with the central authority, at some time in the future it's settled, then you reconcile back from the central authority to make sure they did what they're supposed to do on your behalf, and then sometime later you're accounting and auditing your transaction records. Where if you look at it, that's where every one of those steps has the opportunity to introduce exceptions, errors, and fraud. And there's latency of days, weeks, months, increasing costs and risks between these processes. TradFi is very slow and retroactive in terms of how it fixes itself. So the solution would be to try and compress this time life cycle to as short a time as possible, because the quicker you can either prevent issues or see them, the quicker they can be resolved. The blockchain was supposed to be a solution. It's a distributed network. But if you look at the current blockchains, they can't interoperate with other protocols. Now, there is layer 2 efforts, but again, it's very hard to take one protocol and get it to talk to another. They have the capacity, scalability, and latency issues that we talked about. So they don't always need they can meet some smaller use cases, but when you're dealing with the financial markets, large scale, high capacity, it's just not there. And they lack functionality for ease of adoption. And again, when we're at that digital conference for CBDCs and digital assets, the complaint is that the blockchains are single asset networks that don't interoperate with each other and have scaling and capacity issues. And technically, the errors are retroactively identified and rejected. Now, when I say that, most blockchains require on you proposing transactions for them to be validated. So if you've made an error or you're trying to corrupt the blockchain, it's not that you can't present it, it's just that it should get stopped, but it's getting stopped sometimes later. It's better than today because it's being stopped in minutes or hours, but it's still being retroactively stopped. So our further candidates are to avoid the customization. We need configurable flexibility for the solution, and we also need interoperability, both between networks as well as legacy infrastructure. So looking at DeFi versus TradFi, cryptocurrencies values, I mean, this is changing every day, but basically about 1.9 trillion. 1 trillion of it is Bitcoin. I'm thinking 300 to 500 billion is Ethereum, and then all the others line up to make up the rest of that. But in the DeFi protocols, there's less than 50 billion in total locked value. So it's relatively, billions is for any individual is Elon Musk world, but it's not big in terms of what we deal with in the traditional finance world. And the stable coins, again, only represent 139 billion. If we go to TradFi, we've got this overall stock markets are 140 trillion. The bond markets, government and corporates, is 184 trillion. The FX market is 7.5 trillion a day, but it could be worth upwards of 2.7 quadrillion. And the derivative market outstanding is 1 quadrillion. Now, some of those net down, so the exposure is not as big as it looks, but it's just to give you the idea that TradFi is 100 to 1,000 times bigger than DeFi, or DeFi is 1,000 times smaller. And the point of that is that DeFi has all the innovation, but can't seem to get access to these assets. And TradFi has all the assets, but can't seem to make the innovation work for it. And that's where we're getting to these hurdles. So if we look at DeFi, fundamentally, there's central exchanges which have one-to-one relationships with all the crypto networks. And they're giving you the chance to buy and sell crypto assets in your controlled or their controlled wallets. They may even custody some fiat money for you, and some offer interest-bearing accounts. But fundamentally, it's a buying and selling. And the key thing to note is that when you join one of these exchanges, you get their exchange price. You don't get the market best market price. So there's not an open market for these between these exchanges. If you're looking at the decentralized exchanges, then on a general basis, these are decentralized protocols that you access, and they normally create through smart contracts tokens or some form of entry to Ethereum, so they can create liquidity pool staking, automated money markets, collateralized borrowing, and even derivatives. But fundamentally, you're accessing the protocol to record something on Ethereum. There's obviously other Cardano, TZ, Solana, EOS, or Tron. There are other ones, but the dominant one is Ethereum. Now, if we're looking at TradFi, since 2015, there's been proof of concepts and limited productions and failed implementations, and they cover a host of issues. But if you look at bond issuance, not bond trade, not bond settlement, not bond servicing, trade finance, corporate action instructions, internal repo, meaning you can do a repo transaction as long as both parties are in the same holding company, syndicated loans, fund transfer agent, digital asset exchange, digital asset fractionalization, illiquid security markets or stable coins. Now, the CBDC could be big, but it's still in its early stages. But if you look at all these transactions, they're low volume, small scale, and high latency. And that's, if you think about what we're deciding as some of the limitations, that's why these have been chosen. But yet there's still, while there's some implementation and digital exchanges that exist, they've got limited participation and limited scale and production right now. So if we look at traditional finance versus DeFi, you actually see that it's actually similar. In today's world, you have two parties that are over the counter. OTC means over the counter. That's the bond or derivative markets, or they go to an exchange to execute their transactions. In the crypto DeFi world, you have two parties that either go to a crypto exchange or through a smart contract access other types of transactions. In the TradFi world, the two transactions are then instructed to their clearing broker or custodian via a trade matching engine. They can affirm and confirm the settlement, and they record it in a central depository. In the crypto DeFi world, they go to their crypto custodian, who through a smart contract records it to Ethereum. The transfer agents exist, but they maybe get their data from different sources, but fundamentally they exist for the asset. And then in the TradFi world, you have a regulated way of issuing new securities, which then become perfected in the depository to subsequently be traded onwards. And in the crypto DeFi world, you have a smart contract that can create a digital security, minting it or burning it. Now, when you look at these flows, you can see that fundamentally Ethereum's just become the clearinghouse, similar to the TradFi. So what are the benefits? Well, you've got intraday settlement rather than these elongated settlements. Ethereum is a consistent infrastructure for all assets, and you're dealing with crypto and digital assets. Whereas what the model on the left for the TradFi has to be replicated for nearly every type of product or region. Problem is we've got the performance issues we mentioned earlier. There's no accounting, and we're going to cover that in a minute. And there's no legal recourse. And there's evolving regulations. So part of the hurdle here is that one of the reasons why crypto DeFi has not been able to expand into the TradFi world is because of yes, there's some uncertainty about regulations, but the primary thing is that these are public blockchains that are open source. And if things go wrong, there's no recourse. So a fiduciary or regulated institution has a tough time dealing with these transactions. And then the performance issues have the problem for the TradFi world. So two more requirements. We've got to be able to handle evolving regulations and provide legal recourse. Now I'm going to cover accounting, and I apologize for any accountants on the thing. As much as the devil is in the details, and we're going to get to some of the details, the demise of the devil is in the fundamentals. So I'm just reflecting some simple things here, so it makes it easy to understand. But if you look at a bank outside of its equity, it basically has customer deposits and borrowings. I'm assuming it's not trading derivatives or other things, which the big banks do, but let's just keep it simple. Just a second, someone else just joined. Someone's coming back in. So I'm jokingly saying loans and more loans, and then they buy capital assets. And then if you look at their income statement, there's various costs or earnings, and that makes the net profits retained earnings. So that's very simple on a bank balance sheet. So the idea is it's receiving money and lending money. The liabilities are the payables to the customers, and the assets are the receivables from the loans. And this is the point where I want to get to about money not existing. Because while most people understand a central bank can print money out of nothing, commercial banks can create money out of nothing too. And it's a thing that's called fractional reserve accounting. So if we go to our simple model, you've got a balance sheet where you've got $1,000 deposit by a customer. So if there's a 10% reserve requirement, they have to hold $100, but they're allowed to loan $900. Now, in this world right now, there's $1,000. But once we've loaned that $900 and that person deposits the $900 in their bank, there's now $1,900 in the world, according to the bank records. And that bank is allowed to loan 90% of that, which is $810. And this process continues. So effectively, if you put $1,000 on deposit with a commercial bank, the commercial banking infrastructure can turn it into $10,000. So basically, in this world, 90% of the money actually doesn't exist. It's all created through commercial banking accounting. And if you think about the reserves of most of the commercial banks, around about 8.5%, so that's 12 to 1. Therefore, 11/12 of the money in the world doesn't actually exist. And that's meaning it's reflected by obligations, liabilities, payables and receivables. So if we just quickly look at a broker, it's very similar to a bank, except it usually involves some form of prop trading, or lending and borrowing of securities. So while they can't reflect their customer positions, if they're allowed to, they can lend or borrow them through hypothecation. And they've basically got a very similar balance sheet to the banks, except they've got mainly securities. The banks also have securities with derivative transactions and other things and foreign exchange. But it's just to put it together so that when we do like a combined balance sheet, and this is going into a bit more detail, I don't want to go through all these items individually, but fundamentally, you've got unsettled trades and monies and payments coming in. You've got unsettled foreign exchange. You've got forward transactions. You've got loan cash or securities. You've got derivative contracts on the asset side, and on the liability side, you've got everything that you owe people on the other side of those transactions. Now, these are representing the US requirements that there's certain assets that have to be held for liquidity and capital purposes. But that's fundamentally, so what I'm really trying to join the point is that it's payables and receivables that are predominantly dominating the balance sheet. The interesting thing though, if we can go to T+0, these items go down. These items go down to zero. And therefore, the amount of assets that you need to reserve go down, or you can increase the exposure to these assets. So this is a balance sheet saving to the brokers and banks, which is huge. And that's why they're going to be interested in doing it. Now, they're going to lose some interest in terms of float because they get to sit on money for 1 or 2 days. But the potential is to create whole new markets and get more leverage. So when we look at the industry as a whole, you have financial institutions, you have government entities, and you have private or public entities, and then you have their requirements to issue capital or debt. So you have the banks, the brokers, and the clearing brokers and prime brokers to facilitate that, and then you have the investment funds that then buy these assets. So when you look at all of these things, and this is just terms, rates trading as government bonds, you've got foreign exchange, derivative trades, equities, debt, structured products, debt issuance and equity issuance, and even then private securities issuance. But what we're really trying to show you here is that on the balance sheets of these institutions, you're really tracking the assets and liabilities between each other and the payables and receivables. And so while this is busy, it's really just showing you the relationship across the entire industry with the capital markets. So our candidates are, we need double entry accounting, we need transacting periods, and we need payable and receivables. If we don't, we cannot correctly reflect what's actually happening in the industry. And remember, your blockchain is a distributed ledger. It is a ledger. So if all it's got is fully paid for long transfers, it's not coming close to meeting the requirements of the financial industry. So lastly, I want to come to T+0. in the current market, T plus N, most of the transactions, even a credit card, although you get debited straight away, the merchant doesn't get it for 2 days, or 1 day or 2 days later. So everything's settling in the future, which means that you've got the perfect way to project what your cash needs are 1-2 days in advance. Therefore, you can prepare for the settlements by financing, by having the available cash or securities to settle all your net requirements. If we go to a T plus 0 market, we don't know what the trading desk is going to trade, so how do we fund it? Well, if you've got what they call real-time gross settlement, that means we've got to leave a lot of money lying around just to settle trades that we don't know about, or we've got to have securities available to settle sales. And just remember, a broker, you don't have the assets. Buyers and sellers don't have the assets that they want to transact. A broker sells you an asset that he or she is about to buy, borrow, or get back from loan. And by the way, you don't have the money to pay for it either. Your money's in a money market fund, so you have to redeem the money market fund to pay for the trade. So there's a latency between what it is you've executed and what you've settled. So on the basis of today's infrastructure, it looks like T plus 0 is not possible. Having said that, with distributed ledger, if you have intraday payable receivables, then you can choose to net those by counterparty. You can finance them intraday and actually manage the market as it exists over multiple days today within the same day. But the challenge is that, remember we talked about blockchains having latency or arbitrary latency? You need to have a real-time settlement, because if you have arbitrary latency, you've got uncertainty about recording your obligations, and you've got uncertainty around whether they settle or not. If you've got uncertainty, people are just going to say, let's settle at end of day, or let's settle next day. So the key thing that you really need to facilitate an intraday financing and netting market is real-time settlement. So there you have it. These are the requirements for overcoming the hurdles in financial enterprises. And if you listen to the industry, they're always talking about their capacity. They're always talking about their scalability issues, interoperability issues. They haven't even got to the fact of the accounting issues, and they may complain about some of the regulations or what needs to be clarified, but none of them are close to real time. And what we've done in L4S with Tapestry X was actually to solve for these issues, because these are the fundamental requirements. So rather than taking a solution and trying to make it fit, we said, what do we need to build to make it work? So if you look
Paul, can I pause you for a second? Can we stop and maybe take questions about the requirements? Because I think the section you're going to go into next is about solutions. But I'd like to be able to get a pulse or question, at least give folks an opportunity to ask questions with regard to the requirements. So does anybody have any thoughts, questions, comments about any of these requirements? Yeah.
So yeah, I have one question. So very good requirements, but one of the stumbling blocks for the adoption of Web3 and DeFi has been the incredibly large number of security failures, hacks, and failures of proper financial controls on DeFi contracts. Where does that factor in?
Yeah, that's actually, well, part of it is that when you're dealing with open source, publicly published smart contracts, then you've got to protect yourself. Whereas if you're going, like I said, this idea of this, you're going through an intermediary anyway in terms of a DeFi protocol through whatever internet provider and other access that you've got. So the idea is that we need to have the same controls within the traditional finance institutions, that you are known to somebody. That's why KYC is required, and that you can actually control the process at the front door. So you do need to participate in a permitted or permissioned network to deal with a regulated finance institution. And this is just a reality, which I think some of the DeFi protocols just can't admit. You can't just have this sort of open plan, because there's a real risk of controls, and we've seen hacks, we've seen rug pulls. You're publicly putting your smart contracts on, so people are front running your transactions. And so there's the process. Again, we go back to the banking thing. You can't protect yourself from collusion, but we can make the process of access, secure, with multiple validations, and also it gets into the control of the ledger to prevent the errors or fraud at inception. And that's really what we've got to do with this real-time capability.
All right. Yeah, Paul, you want to go?
Yeah, so when we're looking at this, we look at configurable flexibility and interoperability. We actually have created a way to generically define any asset or transaction, and ultimately, from an accounting perspective, I'll get to the accounting in a minute, all transactions are debits and credits. The irony of it is that we process all these transactions on these unique infrastructures, but over a long extended period, we turn them into a common language, which is accounting. And fundamentally, they are transfers of long assets or obligations, payable receivables. So there's actually a very simple way that we've patented to configure any transaction or asset lifecycle, which now makes the process consistent because it's not customized to every use case. As far as the capacity, the blockchains work based on presenting your transactions to a virtual middle. So they are in some way semi-centralized because they go to an ordering service and a validation and a consensus mechanism, and then they're shared back. We've been able to push the controls to the edge so you can stop the double spend at inception, and you can control the access to the by client, by amounts, by the accounting. And because you're only dealing with now transactions being created and transactions being validated, they're linearly scalable. And there's academic research on what are called conflict-free replicated data types that allow the network to synchronize on the transaction data alone, and so do not require consensus algorithms or independent validators. And again, that allows us to have real-time processing and linear scalability. The lack of accounting in what is called distributed ledgers is really the shocking omission. So again, the memory scalability issue is that you have to keep the entire blockchain in active memory because you don't know who you're dealing with and when they received the asset. If they received it 4 years ago, you need to find the 4-year-old block, and then you need to check every block from that block till today to make sure they haven't spent it. With transacting periods, where we have starting balances, transactions, and ending balances, just like the bank or brokerage statement today, you archive the transactions and carry forward the balances. But with double entry accounting and transacting periods, we can record payable receivables today or future dated payable receivables. If you think about a loan, it's a transfer of money today with a series of future dated obligations to return the money. I often say the current blockchains are a technology of the future that forgot the future because they can only record transactions today and give you the history of where they came from. There's nothing in a blockchain that points to the future. The smart contract may wake up and do something in the future, but you can't project off of it and you can't reconcile it to it without running the algorithm. And that requires a reconciliation, which you can't reconcile to an algorithm. And then the interesting thing is that with the accounting, you're actually operating within the current regulations. Most people are not aware that actually within the current regulations, two counterparties can settle. They don't have to follow market settlement practices. They can settle at any time that they choose to, if they wish to. And also, within an institution or a holding company or within a regulated network, if you don't have to go through the market infrastructure, you can do what's called a book entry settlement. If two people are banking with the same bank, the bank doesn't send the money through the clearinghouse to get it back again. It just does a book entry on its ledger. It says, I'm holding still the same amount of money. It's just that client B has the money instead of client A. And the evolving regulations are beginning to help us because there's clarity around digital. But if you think about it, with the accounting, the only difference between our current process and what's today is the fact that the ledger is distributed rather than being centralized. And that's really the difference between what you may call electronic and digital. But we're really operating with the same accounting as the traditional finance does today. We're just doing it in a decentralized way. Now, the operation of a distributed ledger and how that's shared, and if you start to go into native digital assets, then that's where we have to look at the regulations, but we believe we can operate within those transactions. So here are some links, if anyone wants to talk further, and I'll put them in the chat. Any other questions?
Paul, that's absolutely excellent. Was this presentation going to be available on your YouTube channel?
Yeah, well, hopefully we'll record it, so I'll be able to give it to the GBA, and then it'll be on my YouTube channel, and then we'll see if also on the GBA website, when we get their resources paged set up for the banking and financing group, we may be able to leave a copy of the presentation.
That's awesome. And then you're going to be a speaker at the Future of Money Governance and the Law. So so there's a way people can contact you there if they want to. You want to just talk a little bit about the future of money governance and the law, and maybe the banking. Well, yeah, just talk about that, because that might be of interest to people that are on the call.
Yeah. So within the GBA, I've been an active member for 4 or 5 years, and then recently took responsibility for the banking and finance working group. Overall, the GBA is actually developed beyond these requirements, which are sort of specific to the financial services. The GBA has developed a blockchain maturity model, looking at blockchains from 11 different elements. And then the various working groups, including banking, finance, voting, healthcare, identity, have also developed supplements to the blockchain maturity model so that buyers or sellers of these solutions can be assessed, objectively. And then part of the banking finance group is now these monthly webinars, so that we're hoping we can get people to present various topics and presentations, or have fireside chats so that we can share the information. But in May 2nd and 3rd in Washington, D.C., the GBA is going to be holding the Future of Money Governance and Law, where we've got some pretty significant keynote speakers, but we're covering, multiple aspects of, what is going to happen in DeFi and TradFi, and looking at the solutions. And Gerard, if you want to just quickly cover the keynote speakers. I know one of them is Rick Edelman, who's the famous financial advisor. I believe we've also got the CEO of Circle from the stablecoin. Who else? Gerard, I'm trying to think. But anyway, so it's a 2-day conference. It's not, my experience with the GBA events is that they tend to be definitely more substantive and engaging with the type of people who are there. It's not just a hype fest or a preach to the choir type conference. Gerard, is there anything else you want to say, or we can wrap up?
No, sorry about that. No, listen, I think that sums it up extremely well.
Yeah. All right. If again, I put the links in the chat, so if you want to reach out to understand what some of the issues are, how it relates to your use case or whatever, or our solution, then I'm happy to.
Paul, I do have one other thing real quick, and that is we're going to be doing this series every month. And so I'd love to hear from folks topics that they'd like to hear about following months, as it has to do with blockchain for financial institutions. So anybody have any thoughts or suggestions about other topics that we should do next month or the month after? Or anybody who might want to be a speaker at any of those? I can't believe we've got blockchain people on the line that are bashful. That's it. I'm just hoping that you guys are all not bots. All right. All right. Well, then Paul, we'll come up with a topic for next month, and if you guys keep your eyes out on the LinkedIn page, or go to gbaglobal.org under events, you'll see the events that we have coming up. We'll be doing this every month. Year going forward.
Yeah, and thank you everybody for attending, and look forward to the next event. Right. Thank you.
All right.
Thank you.
Bye, everybody.
Appreciate it.